Everyone, it's Nick with Us versus Herd. We had an amazing day in the market today. I mean, we just kept going and going and going. But I want to kind of share some charts with you. I want to share what's going on in terms of some of the economic data that we're getting in. You know, there's a lot of stuff going on, whether we're in recession, not in recession. You know, a lot of people getting their wires mixed up right now with, you know, the stock market's going up, but data is kind of weird right now. So, you know, let's take a look what's going on here. So, looking at the chart here, I mean, S&P closed back over the 100-day moving average today. It did try last week as well, and then we had 2 red days that failed and thought we were going to come back down, but today we bucked the trend, came back above the 100-day moving average, and you know, it's kind of interesting right in here. You know, what I'm looking at honestly is, are we going to break through basically 4,200? Last time we tapped here back in May, this is what led to the downfall. Tapped it, you know, had a nice reversal here, tapped it, came back down. This actually is what led to the lows on the S&P. So, you know, I'm looking right now, can we break 4,200? And I was looking at yesterday, can we break yesterday's high? Yesterday's high was, what was it, 4140, I think it was. Let's take a look here. Yesterday's high was 4140, and then it came down with all that China news, and then the Fed was laying in yesterday saying, hey, we're not sure if we have inflation under control. Maybe you might need more rate hikes. Kind of see what to do here. But looking at the S&P, I mean, definitely could pump from here. But I'm specifically looking, can we break this area right in here? Looking on the Nasdaq was super strong today, and this thing really rallied. Tech was pretty hot. We had Apple up big, Google, Amazon, and everyone was good. Now this one did break the, similar resistance was being held up here where it was around basically 13,000. Busted through, been holding up above here. Again, this one, Nasdaq is holding the 100-day. And if you guys could do me a big favor, if you like the content so far, hit the like button. Definitely appreciate it. And if you want to join our community, links are below to the Discord, and our options trading group on Facebook. And if you want to learn how to trade options, link is below as well to the UVH Academy along with a coupon code. But where people are getting a little bit mixed up is, a lot of people are claiming, hey, we're all-time highs, we're doing all this, and sure, we could definitely run all-time highs, but we have some hurdles to get around, right? And one of the hurdles right now, credit card balances. Basically, people can't afford to live. So if you're putting money on a credit card, you can't afford your expenses. And due to inflation, last CPI print was 9.1%. We're going to see where it comes in this time. We know the Fed has been raising rates super aggressively and hoping to tame inflation. However, it was a little bit too late. But we have seen oil come down quite a bit. Gas prices are coming down. Stores are starting to give major sales. Hopefully that will kind of let us top out at inflation here. But right now, credit card balances jump 13%, the most in 20 years. This is, although average hourly earnings are up 5.1% from a year ago, prices have risen much faster. So, that's the whole thing. Like, everyone was looking, where was it, like 6 to 8 months ago, there was a hiring bonanza. People were asking crazy amounts of money. And, there weren't enough people to meet the demand. And now we're starting to go the other way, right? And this is where a lot of people started to get, hey, the salary increases. But with those also gave people more money, which caused inflation, and also, all that stimulus money caused most of the inflation. But, basically inflation has been going up way faster, way higher than what your pay raise was. Right? It says here, the gap, more consumers are relying on credit cards to get by, which has helped propel credit card debt to $890 billion. Credit card balances rose 13%. It says, and an additional 233 million new credit accounts were opened in the quarter, the most since 2008. So let's use common sense here. Let's use common sense here just for a minute. Okay. Most credit card accounts were open since 2008. 2008 obviously was the Great Recession. A lot of people say we're not in a recession. But people right now, they can't afford to live. Hey, if we're in a recession, why is the stock market going up? Why are we going up? Why is it ripping up 14, 15% from the lows? Why are we doing this? Why are we doing that, right? Let me just tell you something. The stock market is not the economy, and the economy is not the stock market. Okay, I know. Trump had things mixed up a little bit for everybody, and the traders were getting confused when they thought the economy was the stock market. The stock market was the economy, and that's all you cared about was the stock market. You thought, if the stock market's doing well, I'm going to do well, right? Well, the stock market's doing well. How's the average person going? Not so great. Average person putting everything on a credit card, can't afford to live, can't afford to make ends meet. They have to put it on the credit card. Now, we're going into. We know a couple weeks ago, or a week ago, Walmart lowered guidance. And this is out of ordinary. They didn't have earnings or anything. They issued guidance and said, man, things are going to be bad, right? Just today, they announced that they're going to lay off corporate employees. Comes a week after the company slashes profit outlook and warned that consumers had pulled back on discretionary spending due to inflation. So right now, we're seeing a lot of layoffs, and also what's very important in regards to this, it says shoppers are changing, customers are changing. We are doing some restructuring to make sure we're aligned. So going back to the credit card debt, people can't afford to live. They're buying the necessities. They're not going to Walmart. They're not going to these places to splurge, right? Spending, people are getting tight. People are getting tight right now because they're not sure. Layoffs are coming, and this is how this circle keeps spinning. So, if the consumer tightens, that means less profits, less money for the companies, which then in turn has less money, less profit, too much inventory, and then they go down to cutting their staff, and then the circle just keeps spinning and spinning and spinning until we're kind of off that. But where we're getting the most layoffs right now is tech and in finance, because of mortgage demand way down. It's bad. Especially like Robinhood trading's down, trading revenues are down, mortgages, refinances are down, mortgage applications are down. So finance is getting hit hard, tech's getting hit hard. I mean, I've been reviewing this, and this is up. Since I started reviewing this, I started probably when it was like 20,000 employees laid off in 22. Now we're at 62,000 employees, and you're like, 62,000 is not that bad out of the millions of people who have jobs, and maybe you're right. But right now, how it works is companies cut the fat first. They say, hey, we're going to cut the fat. Robinhood yesterday during earnings, they laid off 23% of their workforce, the number one here. And you can kind of go through here. There's a lot of companies that you'll know, a lot of companies that you don't know, but they're laying off, 100 here, 1,000 here. It really starts to add up, over time. And you're kind of saying, right now we're in this awkward stage of the recession, right? We're kind of in the denial phase. Hey, the worst is over. Inflation may be peaking. We're just gonna coast back up to all-time highs. Now, the reason why some of these companies are doing well is because they made some adjustments, right? Now, one of the companies, most notable companies during last quarter that did, or this quarter that reported earnings just the other day, did amazing, was Amazon. Right, they continue to rip. They ripped higher today. Amazon reported top and bottom beat. They also gave upbeat guidance for the third quarter. Now, going down to here, it's very important. Okay, it says Amazon shaved its headcount by 99,000. So not this quarter, but the quarter before that, they announced they were going to have layoffs. They laid off 99,000 people. Now, what's interesting about this is because they made that change, because they started to pivot, they said, hey, because we made the change, because we had the layoffs, there was a point where inflation was getting out of control and things were getting crazy and our costs were ballooning, gas, everything was going up. Every aspect of our business was going up. Then they laid off 99,000 people. And why they came in this quarter, why they gave better guidance, they said, hey, we laid off some people, we made changes to our business, and this is why the stock is going to move up. Yes, people lost their jobs, but at the end of the day, the company has to do what's right for the company. Regardless of what's right for you or me, right? So if I get laid off, but the company is doing well, that's okay, right? I mean, So I mean, just kind of think about that. Now we have 99,000 people laid off. Amazon's doing better, and those people potentially are maybe not. Maybe they're going to get hired somewhere else. Maybe they're not going to get hired somewhere else. But that's how you kind of get into this awkward phase where, hey, companies are making the changes to be profitable in this atmosphere at the expense of jobs. So this is very, 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 very important where stocks can rally and they continue to rally. And we'll look at Amazon, right? Amazon, after earnings, is continuing to rally even though they're laying off people. But layoffs, I hate to say it, layoffs are good for a company because they spend less money. They're cutting the fat. Now the question is, after they cut the fat, what's going to be left over? Are they going to have to dip into the people that are helping the company grow? You know, those are the people that get laid off last. The people that are helping the company grow get laid off last. So when we start dipping into that is when we're starting to get into some recessionary trouble. But I just kind of wanted to make a video about this because there's a lot of confusion on, you know, what's good, what's bad. Hey, I thought layoffs are bad, and you know, sure, you know, if you're a worker that gets laid off is bad, but if you're the head of the company making a business move, it is good to be continued during high inflation and you're trying to get costs under control. So yes, you're going to have layoffs to get your company under control and things off to a better start, right? So let me know what you thought in the comments. If you watched this video to the end, leave a comment. Let me know how you did. As always, stay safe, stay green. It's us for a cert.